Hi there, welcome back to Trading Options Network. In the last lesson, you learned the very basics of options contracts. What is a call? What is a put? What are strike prices? Etc. In this lesson, we're going to dive deeper into how to read those contracts. It's vitally important you understand what contract you are buying or selling and not rush while looking over the data, otherwise you will end up doing something you do not mean to do. Believe me, I have done it, and I guarantee at some point you will too. In other words, I'm really just trying to stress how important it is to take your time in reading the data, understand what you're looking at, so you can make the right decisions. That being said, let's go ahead and get into this lesson. So now that you know what an options contract is, how do you open one? In the last lesson, you learned the very basics of options contracts and should be able to tell me the difference in buying and selling both calls and puts, and why or when you would want to do it because you have all that information now locked in your brain. But how do you actually do it? The next step in the process is understanding something called an options chain. This is where you will find all the information for each and every available options contract for a particular stock. In this illustration, I'm going to use a small table graph. However, every software and trading platform will be slightly different. Now, let's fill it in with some data. There we go. Now, obviously, you should see the stock and/or stock ticker symbol on the options chain because it only makes sense that we know what the underlying stock is of the options we are looking at. In our example, we are looking at the options chain for ABC Corporation. It will also show the share price so we can compare the strike prices to the actual price. What is the definition of a strike price, by the way? If you said the predetermined price that an asset, in this case shares of ABC stock, can be bought or sold, you are correct. You'll also be able to see the expiration date of the options you're looking at, which are going to be in the form of day, month, year, and you should also see the number of days until expiration. The number of days to expiration are calendar days, by the way, not trading days. On the left side of the chain, you should see call information, and on the right side of the chain, you will see put information. Down the middle of the chain, you should see different strikes. Let's dive deeper into these strike prices. First one I'll point out is the 50 strike. What is the significance of this strike price? Well, if we look at the share price, it is exactly the same. This is known as at the money, or ATM for short. On a side note, while to be truly at the money, the strike price and the share price do have to be the same, but oftentimes, many traders will consider the closest strike to the share price as at the money. Now, if we're referring to calls, any strike with a value under the share price is known as in the money, or ITM for short, and every strike with a value greater than the share price is known as out of the money, or OTM for short. On the flip side, if we're referring to puts, the strikes with a value less than the share price are out of the money, OTM, and the strikes with a value greater than the share price are now in the money, ITM. But what exactly makes an options contract in the money or out of the money? Two words: intrinsic value. An options contract is said to be in the money if the intrinsic value is greater than zero. Now, I know what you're thinking. Brett, you're confusing me. What the heck is intrinsic value? Well, plain and simple, intrinsic value is the value you would receive on your shares if you exercise your option, or also seen as the difference between the strike price of an in-the-money option and the stock price. The remaining value of an options contract is called the extrinsic value, or the difference between the total premium of an option and the intrinsic value of the option. It is also known as the time value of the options contract. We'll certainly be going over extrinsic value more in different lessons, but to give you a little bit more of an understanding, the further away a contract is at from expiration, the longer the underlying stock has to move and become more profitable. Therefore, the longer the expiration, the higher the extrinsic value. Let's look at a couple of examples of in-the-money and out-of-the-money options. From the options chain for ABC stock, let's say we were the holder of the 47 strike call. The share price is $50, while we own the 47 strike. We can see the premium for the contract is $3.70. If we subtract the strike from the share price, we are left with $3, which gives us our intrinsic value. Because the total premium is $3.70, if we remove the $3 intrinsic value, that gives us an extrinsic value of 70 cents. To reiterate the intrinsic value here, if we exercised our 47 strike option, we would buy shares of ABC stock valued at $50 for $47 each, giving us a value of $3 on our shares. That's the intrinsic value. Now let's say we're the holder of the 53 strike call option for ABC stock. While the share price is $50, this would provide us with zero intrinsic value because if we were to exercise this option, we would buy shares at $53 when the value of the shares is only at $50. So we would be in the red already, aka losing money. Hence, the premium for this contract is built up of only extrinsic value, meaning if you were to buy this option, you're simply paying for the time it has before it expires, nothing more. But what about in the money versus out of the money puts? If you recall, the strike prices of the put options with a value higher than the stock price are in the money, and the strike prices of the put options with a value lower than the stock price are out of the money. Completely opposite of call options. Let's look at the 52 strike. With a share price of $50, a strike of 52, and a premium of $2.80 based on our chart, we can say that we have an intrinsic value of $2, $52 minus $50, and an extrinsic value of 80 cents. If we look at a 46 put, according to the chart, we'll have a premium of 35 cents, an intrinsic value of 0, and an extrinsic value of 35 cents. Again, intrinsic value is the value you would expect to receive if you exercise your options. So in the case of puts, you only have intrinsic value if you sell your shares for a price higher than the current stock price. Now let's go back to our full chart. Most softwares will allow you to customize the option chain how you prefer, but on top of everything we've already discussed, you will always see the bid and ask prices as well. To put it simply, the ask price is the price you should, for all intents and purposes, be guaranteed to buy an asset for, while the bid price is the price you should be guaranteed to sell an asset for. This brings up something called the bid-ask spread, the difference between the ask and the bid, but that will be talked more about in other training videos. The other values you see are typically interchangeable, but a couple very common values you will see are called volume and open interest. Volume is the number of times the particular asset was sold during that trading day, in the case of stocks and options, while the open interest is the number of contracts that are currently open that have not yet been exercised or closed by the holder. Both of these numbers can be used to help give you an idea of what is the overall sentiment of a stock. Now let's review. This lesson was all about the options chain, which is a table or chart that contains all of the information for each and every available options contract for a particular stock. An option is considered at the money when the share price and the strike price are exactly the same. An option is considered in the money when the strike price is below in the case of a call, or above in the case of a put, the share price, giving it intrinsic value, whereas an option is considered out of the money when the strike price is above in the case of a call, or below in the case of a put, the share price. Intrinsic value is the value in your shares if you were to exercise your option, or known as the difference between the share price and strike price of an in-the-money option. Extrinsic value is the time value of the contract. The bid is the price of an asset you should be guaranteed to be filled should you sell, while the ask is the price of an asset you should be guaranteed to be filled should you buy. The two together create something called a bid-ask spread, which is simply the difference between the two. Volume is the number of times an asset has traded in a particular time frame, and lastly, the open interest is the number of held contracts yet to be exercised or closed. Well, there you have it. You now understand how to follow an options chain. There is a lot of information in this lesson, so if you have to watch it multiple times, do so. That being said, don't forget to bookmark our page, tradingoptionsnetwork.com. Subscribe to our YouTube channel at youtube.com/@thetradingoptionsnetwork. And don't forget to follow us on Facebook, Instagram, or TikTok to stay up to date with all of our latest videos. That being said, I hope you have a great rest of your day.